Hey everyone, welcome back to Corporate Decoder, the place where we take apart these massive financial documents and pull out the juicy bits, like finding a diamond in a mountain of paperwork, or maybe in this case a slightly tarnished old coin. Get ready, because Mallinckrodt PLC's latest financial report is here, and it is a wild ride of deals, acquisitions, and some serious financial juggling. We're going to break down the numbers, see what they really mean for the company, and figure out if this is a story of growth or just a company trying to keep all its plates spinning. Alright, let's dive into this report from Mallinckrodt PLC. It is a quarterly check-in, a Form 10Q, giving us a snapshot of their financial health as of the 26th of September 2025. First up, the top-line revenue for the 3 months ending in September 2025. Mallinckrodt pulled in $753.1 million. That is a big jump, a nearly 49% increase from the $505.5 million they made in the same 3 months of the previous year. On the 9-month front, sales hit $1,658.1 million. Up about 11.5% from last year. This looks good, right? More money coming in is always a positive sign. But here is where it gets interesting. A huge chunk of this sales increase, a whopping $274.5 million in the 3-month period, comes from a massive deal they closed on the 31st of July 2025. They officially bought a company called Endo, so while sales are up, it is important to remember this is largely thanks to an acquisition, not necessarily organic growth from their existing products. They also specifically mentioned that new sales from Endo's Siaflex product alone added $90.1 million in sales for the quarter. Their big product Actar Gel also saw a nice boost, bringing in $181.4 million in sales for the quarter, a 43.5% jump. This growth is thanks to a growing market, more marketing efforts, a new product called Self-Ject, and making it easier for patients to afford. It is good to see their established products are still performing well. However, they also sold off a business called Theracos in late 2024. This sale actually took away $67.6 million in sales for the quarter compared to last year. So while they gained a lot from Endo, they also shed a part of their business. It's a strategic move, but it shows why comparing apples to apples can be tricky with big corporate changes happening. Now, let's talk about gross profit, which is basically what is left after they pay for the direct costs of making their products. For the 3 months ending September 2025, gross profit was $254 million. That is an increase from $221.1 million last year. But here is the catch. Their gross profit margin actually dropped significantly. It was 43.7% last year. But it is down to 33.7% this year. Why, the report explains it is due to buying lower margin products from Endo, and also a lot of extra costs related to valuing the acquired company's assets, like inventory step-up costs and intangible asset amortization. This means that for every dollar of sales, they are pocketing less profit than before. And the costs don't stop there. Selling, general and administrative expenses, or SG&A, which covers things like marketing salaries and office costs, absolutely skyrocketed. It went from $141.2 million last year to a whopping $351.7 million this year. That is a nearly 149% increase. A big part of this is due to the Endo acquisition, bringing in new costs, but they also spent a lot more on new compensation, including a massive $109.3 million related to something called the Transaction Incentive Plan, or A&R trip, designed to reward executives for these big deals. On top of all that, they've got $93.8 million in combination, integration, and other related expenses just in this quarter. This is basically the cost of merging the two companies, think lawyers, consultants, and making sure everything fits together smoothly. There were no such costs last year, so this is a brand new, very expensive line item. And we cannot forget about debt. Interest expense jumped from $59 million last year to $70.6 million this year. This is mainly because they took on a lot more debt to pay for the Endo acquisition. It is like taking out a huge mortgage on your house. Suddenly, your monthly payments go way up. On the tax front, they actually recognized a tax benefit of $35.9 million this quarter. This sounds great, but it is linked to their overall losses. Their effective tax rate is 11%, which is lower than the Irish statutory rate of 12.5%. The report mentions this is due to a mix of earnings in different countries, funny accounting rules from their past bankruptcy, and those really high non-deductible employee costs and merger expenses. Last year, they paid $7.2 million in income taxes, even though they also had a loss, leading to a negative tax rate. It shows how complex tax situations can get, especially after big financial events. Now, circling back to those strategic moves, after buying Endo, Mallinckrodt wasn't done. They turned around and on the 10th of November 2025, they separated their generics and sterile injectables businesses into a new private company called Par Health. This was done by effectively redeeming preferred shares. This separation means Mallinckrodt is now smaller and less diversified, which can be a double-edged sword. It might mean they can focus better, but it also means they are more vulnerable if things go wrong. And that brings us to a major risk factor. Because Endo was acquired, Mallinckrodt now inherits Endo's massive bankruptcy issues. Endo went through bankruptcy in 2022 and 2024, and certain parts of their business are still operating under strict court orders. For example, they have a voluntary opioid operating injunction that prevents them from manufacturing high-dose opioid pills, advertising opioids to patients and doctors, and offering compensation incentives based on opioid sales. Any slip up here could seriously harm Mallinckrodt's business. Mallinckrodt is also facing quite a bit of legal heat. There is a securities lawsuit, the Continental General case related to statements made about their financial strength and ability to handle opioid litigation settlements. While Mallinckrodt itself had those liabilities wiped clean during their own bankruptcy, they apparently agreed to defend and indemnify the individual defendants for $5.5 million. It's a significant legal cost even if it is for past issues. Environmentally, there is the Lower Passaic River cleanup. This is a long-standing issue, and Mallinckrodt's share of the estimated cleanup costs is around $21.2 million. It is an ongoing commitment, and the final cost is still a bit uncertain. Stepping back to look at their overall financial picture, Mallinckrodt is facing significant interest rate risk. They have a lot of variable rate debt, meaning their interest payments can go up if interest rates rise. They've got about $2.685 billion in variable rate debt right now. If interest rates go up by just 1%, their annual interest costs could jump by almost $27 million. They have a cap on some of this risk, but it is a big exposure. Let's talk about their debt situation. As of September 2025, their total debt principal is $3.7 billion. This includes about $2.5 billion from the Endo acquisition and a new $1.2 billion loan. This is a heavy debt load, and the report highlights that they now have a higher debt to equity ratio thanks to the deal. They paid off some of their old debt using new loans, but it means they are carrying a lot more financial obligation. So what is the story here? Mallinckrodt is clearly in a period of massive transformation. They've made bold moves by acquiring Endo and then quickly spinning off parts of the newly combined entity. On one hand, their reported sales are up, driven by the Endo acquisition, and some key products like Acthar Gel are still growing. They've also managed to refinance and restructure some of their debt, which is crucial for survival. However, the costs associated with these deals are staggering. The increase in SG&A integration expenses and interest payments paint a picture of a company under immense financial pressure. Their gross profit margin has also taken a hit, suggesting they are making less profit on each sale. The biggest red flag, though, is the inherited baggage from Endo's bankruptcy and ongoing legal battles, especially those related to opioids. The separation of Par Health makes them a more focused company, but also a less resilient one. They are now relying heavily on the success of their specialty brand segment, particularly Acthar Gel and the newly acquired Shaflex, to carry the financial load. The sheer amount of debt they are managing is also a constant risk. My take is that Mallinckrodt is navigating a very complex financial landscape. They've made some aggressive moves to restructure and grow, but the financial strain is evident. The success of this strategy hinges on their ability to integrate Endo effectively, manage their debt, and resolve the lingering legal issues without further significant financial blowback. It's a high-stakes game, and the next few quarters will be critical to see if they can truly turn things around, or if they are simply rearranging the deck chairs on a financial Titanic. Investors will be watching closely to see if the projected benefits of these massive corporate shifts actually materialize, or if the costs and risks continue to outweigh the rewards. That is our deep dive into Mallinckrodt's latest report. What do you think about their strategy and the future of the company? Let us know in the comments below if you found this breakdown helpful. Smash that like button and subscribe for more decoded financial stories. And don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next Decode.